Hi there. It's time for our webinar again this week, and I think this one is probably as timely as any webinar that we've done thus far. However, I really try to make sure that everyone is not only relevant to what we're doing, but fits the climate of the market, of the business, of the year, of the advisors, that it really, I want it to be meaningful to you. And right now, the market had a dipsy-do day yesterday. It's up and down and all around. I've seen negative reports in the paper, and I just want to be sure that you understand what's really important about the market. This is not just for your benefit, but for your benefit to talk with your client. The truth is, we all have clients, whether they are in an indexed annuity, who get nervous at any market drop. If they have a retirement account that has mutual funds in it, they get very nervous. If they have any kind of investment in the market, and if you are a fully registered representative, and I hope all of you are, and if you're not, that you aspire to be a fully registered representative, because unless you are taking this role seriously, you'll continue to be part-time and sometime, and you won't receive or achieve the kind of success you really want. And I know what kind of success you want, because I know what kind of success I wanted. I didn't want to be okay. I didn't want to be doing good. I wanted to excel. If there's a chance to be number one, I wanted to be at the top of the list. I wasn't all the time, but it wasn't because I didn't try. And if you are fully registered, that means you really want to try. You want to make the most of your opportunity. You know, Thomas Edison said, one of the problems with opportunity is it shows up and knocks at the door wearing overalls, which means work clothes. Opportunity and success comes with hard work. Registration is preparing you for that work. So trust me, it's going to make a difference in your business. It's going to make a difference in your production, in your income, and in your life. But if you're going to be fully registered, you're going to have to deal with a market. So today we're going to talk about market woes and market knows. What this is what every advisor needs to know and share. It's really important that you understand how this works. So let's start. I want to share with you some things that I think are really important as we look to the future. One of the things I think is critical is that we understand that there's the only sure thing that's out there. The only sure thing, and I'm sure most of you already know exactly what that is, you already know that the only sure thing when it comes to the market, and by the market I'm referring to the stock market, to the Dow Jones, to the S&P, to investing in equities in any form or even in bonds or fixed income, the only sure thing is this. There is no sure thing. I mean, that's the truth. There's no sure thing. Even if we try to get an investment that is always going to work, involve no risk, we're giving up so much to get that it's very difficult to achieve what our goals are when we made the purchase. There's no sure thing. Is that bad? Well, it just reflects the truth, right? Interest rates change. Most of you know that Gloria and I moved to Jacksonville, Florida area last year. We got a mortgage at a little better than 3.5%. Rates now are 4.5 to 4.6 and higher. Interest rates change. That scares the market. Why? Because fixed income becomes an alternative for investing in the markets. Most of us don't believe that's true, but there are those who do. And for that reason, the market is affected when interest rates go up. And then economies change. One of the things that happened when our current president, President Trump, was elected is the markets took off. And they've been going up since. Part of the reason was that he was bringing about a change in the economy with tax cuts, which stimulates growth, also tax cuts for corporations, which stimulated spending, and that's changed the economy. But the economy can also go in regression. It can go in depression. The economy can slow. All those things happen. So that's the reason there's no sure thing at all, because economies change. The other thing is that politics change. Goodness gracious. The change from this administration to the previous administration, from being market-friendly, business-friendly, investor-friendly, to one that says, look, our goal has nothing to do with those things. We want to be sure we're people-friendly. And for some reason, lowering taxes, stimulating business, trying to provide more income, didn't seem to some as people friendly. But politics change, and who knows when they may change again. The other thing is perception changes. What does perception mean? You know what it means. It means that what people perceive to be true changes. What people believe to be positive, business friendly, optimistic changes to being negative, pessimistic, and this is not going to work. Perception changes. And that means there's no sure thing, because people's opinion, people's perception of any event always goes through change. The other thing is that patterns change. Goodness gracious. As an investor, there are those who are market timers, market analysts, market savants who do all the time studying the market, and they look for patterns. They look for breakouts or breakdowns. They look for creating bases, or when it breaks through resistance. There's all sorts of patterns out there. But patterns are always doing what? They're changing every day. And the truth is, you can't predict tomorrow by looking at yesterday. You just can't do that. You can't do that. Patterns will change. And thinking a pattern is going to always continue is the height of fallacy. And then there's global change. Yesterday, when the market was hitting, having a big down day, it was because Italy changed. What? Italy changed? Yes, their government is considering a change that may affect the euro. What does that have to do with anything? Well, that changes how the European economy works, how capital flows, how money flows, how people flow, how business changes. And so because Italy may change, there's a global change, it changes everything. Even though things are more positive sometimes in this country, change around the world can become negative. There's no sure thing because of all these changes. So what do you do when your clients are saying, I can't be sure anymore? I mean, I thought this was going to work out and it didn't. I thought this was going to go up and it's down. I thought this was going to protect me, but it didn't. What happens? What's the first choice when you see change of any sort? Politics, perceptions, economies, what happens? Well, here's the first thing for sure. It's that fear rules the day. I don't need to remind you that no one likes change, especially markets and investors. The only change they like is positive. But the truth is, perception changes. Everything changes. And the first choice is to have fear rule the day. And when fear rules, logic flies out the door. This is what happens. When fear rules the day, the first thing everyone says is, well, I'm not going to add any more money. I'm just going to hold on where I am. Don't ask me to change. Don't ask me to do anything. I'm really uncertain, so I'm just going to hold on to what I've got. And then when they say I'm going to hold on to what I've got, well, at this level, this may be a good time to add new money to that position. But the investor says, no, I don't know what's going on here. Fear rules the day. I'm not going to add any new money. It just doesn't seem to make sense to me right now. I'm going to hold on to what I have. I'm not going to put any new money in. Just going to see what happens. And then it gets sometimes a little more unsustainable. Change starts happening everywhere. And then they say, so where can I go for safety? What bonds can I buy? Or what fund can I buy? Or what manager can I trust? Or can I go to cash? What do I need to do here? So when fear takes over, you hold positions, don't add money, start saying, where can I go for shelter? And the first out takes place because suddenly they find there is no out. So I'm going to sell some of my position. I'm going to take profits. You will hear that all the time. You know, I'm kind of getting back to where I was, and I don't want to lose what gains I have, so I'm going to sell. That's the first out. The investor decides, my first out is to limit my exposure, to take profits, or to protect my gains, or to hold on to my cash, and that's the first out. The problem is, change continues. And you think, oh my goodness, it didn't go back up. I don't know if I should buy or sell right now. What should I do? And then as negative emotion takes place, negative sentiment takes place, negative news takes place, say, well, I'm gonna get out of more of my positions. I've had a good run with this fund. This has worked out really well. How can I change the investment in this annuity? What can I do? And the second out takes place. And nervousness breeds more nervousness. And the first people gone, second people are gone. Then you have the third guy say, I'm not sure about those guys. But then the third exit is dramatic. That's when the guy says, I don't want to be in this anymore. I just can't stand it emotionally. My wife and I can't take it. It's just too volatile. I didn't know it was going to be this volatile. Right now I'm actually losing money. I'm afraid to get out, but I'm afraid to stay. So just get me out. Just get me out. It's pretty dramatic. And you'll see major corrections when that takes place. But here's the worst. There are guys that will say, the nervous Nellies are gone. I'm not getting out. Everything's still okay for me. I like my investments. They're going to hold on. Then when they see everybody dropping and everybody leaving and the market drops down 50, 100, 200, 700, 1,000 points, 2,000 points, then everybody says, oh, man, I don't want to be the last guy here holding the bag. Get me out of here. And everyone runs for the exit. And when that happens, you have complete market capitulation. And the idea is there's a new normal. This is never going to change. That happens over and over and over again. Let me just tell you, when I first became a financial advisor, the market was at 728. No, not 7,000, 728. And a market guru named Joe Granville said, it's going to go to 500. And then everybody got out. Nobody wanted anything. It was all done. And you know what that meant? That's the bottom. Why? Because there's tons of cash on the side and there's nowhere to go. Just nowhere to go. And then people start creeping back in again. I watched it go from 700. We were talking about it going to 1,000. They said, oh, never in my lifetime. Right through 1,000. Said, well, 2,000 could be. 2,000, doubling from here, it'll never happen. Bam, 2,000. We think we could see 5,000 on the market. 5? Are you crazy? The market's bow right through 5. Bow right through 10. 15,000 on the Dow. No, that'll never happen. I was doing presentations saying the Dow could reach 15,000, and people thought I was absolutely out of my mind. Bow right on through 15. Now look where we are. Listen, you cannot try to follow the sentiment of people around and do well in the market. You just can't. So when final capitulation comes, you still want to be one of the guys there. And here's the problem. When you sell everything, you get afraid to get back in. When would you get back in? When would you buy again? You can't decide. So there's a second choice. And the second choice is this. Fear is not feared. How can that be? When my children were small, we would go to carnivals and fairs. There was always a haunted house. And what did you expect when you went in the haunted house? Well, they expect to be scared. They knew they were going to be scared. That's the reason it's called a what? Haunted house. I mean, they knew they were going to be scared. So they weren't afraid of it. It's a whole lot different when they're in their bedroom and it's dark at night. You're hearing funny noises. But when you expect it, fear is not feared. So here's what I'm telling you. Expect market change. Expect perceptions to change, economies to change, global change, interest rates to change. But if you expect it, don't fear it. It's going to be there. And then it changes everything because sentiment is usually wrong. Market sentiment is usually wrong. That's because it's looking backwards, not forwards. When everybody says, oh, it's woe is me, nothing's going right, the economy isn't going right, the markets aren't going right, corporations are being poorly governed, there's chaos in the world, no one has any money. All that sentiment is usually true about what it's talking about, but wrong when it's talking about what the market's going to do. And the truth is, the crowd is seldom right. I remember seeing someone wearing a ball cap once, and it had a bill on the front, a ball cap bill on the front, and a ball cap bill on the back. And it said on the front of the hat, follow me. Which way did they go? Can you imagine a leader who says, follow me? Which way did they go? I mean, that's the way people are with the crowd. You cannot follow the crowd and make it. The crowd is always wrong. They never know what is right, especially when it comes to the market. You have to be an individual. You have to think for yourself. And you have to remain optimistic. Why? Because the truth is, thinking may be the enemy. I've told you the stories about Pogo. Pogo was a cartoon character many, many years ago. He lived in a swamp, but Pogo was a little possum, and he turned to his friends once and said, you know, we've seen the enemy, and they is us. Most of the time, we get ourselves in trouble. We start thinking too hard. Well, what if I did get out? It would be better if I did that because, gosh, I've got this coming up in the future. I want to be sure that I can retire when I want to. And we start thinking. And thinking becomes not thinking anymore, but worry. And worry becomes a burden that we bear around. Just understand that fear is normal. It is normal. The markets do not always go up. A tree does not always go to the sky. And yet, the market keeps making its inevitable climbs. 750 to today, oh my goodness. It happens over time. And that's another important lesson we want to learn. The opposite action when everyone is selling is buying. Do you know how you make money in the market? When I do seminars for clients, I say there's one guaranteed way to make money in the market. This is the only guarantee. It's to buy low and to sell high. That's the only way you can make money in the market, to buy low and to sell high. Would you agree? Of course, everyone agrees with that. That's the only way you can do it. But how do you buy low? You buy when nobody wants to buy. You buy when everybody's left the party. You buy on the bad news. In fact, the old market wisdom says buy on the bad news and sell on the good news. The only time you can make money in the market is buy low and sell high. The only time you can buy low is when the news is bad. So that's the opposite action when everybody else is doing. When everybody else is selling, it's a good time to think about buying. The opposite is very difficult, but if you're not afraid of fear, it's okay. Holding on is difficult, but it's necessary. The Motley Fool is one of the stock market advisory services that I enjoy. It looks at different options. It's not a big institutional analyst. It's just it's a group of Motley Fools. And Motley Fool said not long ago, Dave and Tom Gardner said, we would have been better off had we never, ever sold a stock. Do you know, if you bought a stock for the right reason, you should still hold it for the right reason. Unless something goes wrong with the company, if they had product recalls or management changes, or they've fallen out of favor because they haven't kept up with the technology. There are all kinds of reasons, but holding on is what you generally ought to do. Don't capitulate. Let me just say, let's say you like a stock and say, but I'm getting out. When do you buy back in? Most of the time, you wait till it's too late. You know what most investors do? They buy high. Wow, things are looking really good. And they sell low and they lose money. And then they wonder what happened. Listen, holding on is difficult, but it's necessary. And then being a contrarian is what you have to do to be successful in the market. What does that mean? That means you do the opposite of what the crowd is doing. You behave in a contrary fashion. Contrarians are guys who are steadfast investors. They are also steadfast and successful investors. Don't worry about being a contrarian. Don't be afraid of the fear. Just go right on. So what would you do in today's market? Suppose you're marketing an indexed annuity. Suppose you're marketing an indexed annuity with the floor. But a client says to you, I don't know, things are looking unsteady. Suppose you're recommending an outstanding mutual fund for a 401k, coming out of bonds and going into an equity fund. I don't know. It really scares me right now. What should you do now? Well, it's impossible to time the market. I want to say it again. It is impossible to time the market. Will the market go up to 30,000 from here? I don't know. Will it go to 10,000 from here? I don't know. It's impossible to time the market. No one knows how to time the market. No one can do it. If they could, they'd be multi-billionaires and doing really well and not trying to tell everybody else how to do it. It's impossible to time the market. So be sure that your clients know and understand that we can't decide the right entry point or the right sell point. You just can't do it. Do you know who this is? If you know who this is a good time for a quiz. Why don't you just type in and let Mark know who you think this is? Who is this old guy with gray hair who's standing in front of a board talking as if he knows what he's talking about? Who is that guy? And why do we care? Who? Did you guess who he is? Do you know why his picture's there? Many of you have typed in words. You've typed in your answer. Let me just tell you. He is Warren Edward Buffett. He's an American business magnate, an investor and philanthropist who serves as the chairman and CEO of Berkshire Hathaway. Berkshire Hathaway is, as you know, listed on the New York Stock Exchange. He's considered one of the most successful investors in the world. And just a few months ago, he had a net worth of $82.9 billion. $82.9 billion. He's the third wealthiest person in the world. Warren Buffett, third wealthiest person in the world. The Sage of Omaha, he's called. Now you think about it. The sultans who have huge wealth, the others who have huge wealth, this guy created his own wealth by being an astute investor. So do you think he has anything to say to us? I mean, might his thoughts be appropriate for you and for your clients when we get in a period of chaos? Well, I think so. Here's what he said. Remember I told you holding on is what you really need to do? Here's what Buffett says. Our stay put behavior reflects our view that the stock market serves as a relocation center at which money is moved from the active to the patient. What does that mean? That means if you're buying and selling, you're trying to time the market, you're trying to get out the high and buy at the low, or you're getting out the low so you can protect yourself. Those active traders lose money. When I was at Merrill Lynch, I created an investment called the Dow 10. We bought the 10 high-yielding stocks in the Dow. We held them for a year, collected the dividends, and then sold the ones that were no longer at the bottom of the market. It's a strategy that works and works and works. The gentleman who wrote the book, Beating the Dow, lived in Albany, New York. And when I went to visit him, I said, Michael, how come you live in Albany, New York? He said, because the further I am from Wall Street and New York, the better off I am. Because when I was in Wall Street, every day they pay me to do something. And the very best things I could do for my clients was to do nothing. That's just what Warren Buffett is saying. Look at what Buffett said. We continue to make more money snoring than when active. In case you didn't get the point from the first quote, we continue to make more money when we're snoring than when we're active. That's what you want to be, as a patient investor who takes time and understands the truth. The only value of stock forecasters is to make fortune tellers look good. That's a great quote, isn't it? The only value of stock forecasters is to make fortune tellers look good. And we know how accurate, how wonderfully positive fortune tellers are. Warren Buffett. I think we could learn something from this experienced, not just experienced, but successful investor. So how long should you hold, Warren? Well, my favorite time frame is forever. My favorite time frame is forever. Let me just tell you, in my portfolio, where I've had the greatest success is when I've followed Warren Buffett. There's stocks in my portfolio I've had for years and years, through down cycles and up cycles. And when you look at the gains in my portfolio, they've come from those things that I bought and held no matter what, because I bought them for the right reason and I kept them for the right reason. Warren Buffett. Well, what about Peter Lynch? Do you remember Peter Lynch? He was the most successful money manager in the world. He ran the Magellan Fund. The Magellan Fund made millionaires out of people who bought the Magellan Fund. And he ran it for years and years and years. Peter Lynch. He wrote a book called One Up on Wall Street. That's been a huge bestseller. Well, what would Peter Lynch say? Does he agree with the same things that Buffett says, or is this a chance to see what a contrarian says? Well, Peter said far more money has been lost by investors preparing for a correction or trying to anticipate a correction that was ever lost in the correction themselves. What he's saying is more money has been lost by investors getting out of the market or trying to figure what's going to come and get out than was lost by being in there when the correction happened. Yeah, more money's been lost by investors trying to time the market and get out on time than was even lost by going through the correction. Look what he said. I can't ever recall once having seen the name of a market timer on Forbes' annual list of the richest people in the world. If it were truly possible to predict corrections, you'd think somebody would have made billions by doing it. Just not possible. In fact, the only guy who's made billions is the guy who says you can't do it. Jason Zweig, another famous money manager. Whenever some analyst seems to know what he's talking about, remember that pigs will fly before he'll ever release a full list of his past forecasts, including the bloopers. You know, if you ever watch CNBC and you'll hear the guys come on and talk about this and talk about that, just let them show you their track record. Charles Ellis, again, another famous money manager, said, market timing is unappealing to long-term investors. As in hunting deer or fishing for rainbow trout, investors learn the importance of being there and using patient persistence. So they're there when opportunity knocks. You know, if you get out, you have no idea to get back in when the market's moving again. You just can't. Jonathan Clements, who manages a large fund, said, what do you do when the market goes down? Read the opinions of investment gurus who are quoted in the Wall Street Journal. And as you read, laugh. We all know that the pundits can't predict short-term market movements, and yet there they are, trying to sound intelligent when really they haven't got a clue. So what should you know? Alan Abelson, who's the editor of Barron, said, you know what investing for the long run but listening to market news every day is like? It's like a man walking up a big hill with a yo-yo and keeping his eyes fixed on the yo-yo instead of the hill. I love Bernard Baruch, one of the best investors, most successful investors early in Wall Street, said, only liars manage to be out during bad times and in during good times. Oh boy. You ever heard anybody tell those big ones? I hope not. David L. Babson, a mutual fund company, the owner of a mutual fund company, said, it must be apparent to intelligent investors that if anyone possessed the ability to do so, that's forecast the trend of stock prices consistently and accurately, he would become a billionaire so quickly, he wouldn't find it necessary to sell his stock market guesses to the general public. You know, every time somebody's telling you they have a system and they can make more money for you than anybody could, I'm just guaranteeing you this guy is not wealthy because he doesn't have to spend the time worrying about doing that. Market woes or market knows? Here's what the market knows. And here's what you ought to know about investing for your own account, what you ought to know about investing for your children, for their educational funds, funds that may be currently in the market, investing for your retirement accounts, investing for your 401k, investing in your retirement plan at work. Here's what you need to know. The first thing is this: time in the market is more important than timing the market. For the years and years and years, I tried to teach and work with financial advisors in Merrill Lynch. This was the most important thing I said ever. Time in the market is more important than timing the market. Why? Because you can spend time in the market, but you cannot ever learn to time it. That's really important. Here's the second. Performance is personal. What does that mean? If the Dow Jones is up 25 points or up 1,000 points, what does that mean to you? It means nothing. I don't own the Dow Jones Industrial Average. I don't own the S&P. Performance is personal. I know that if I can get 7% and average that for 10 years, my money will double. 7% a year on an average will double my money. You know how the Rule 72 works. It's a wonderful thing. So I'm not chasing big gains. Performance is personal. For some of your clients, they don't want to make big money. One of the best quotes ever is Will Rogers was once asked by a financial advisor, what would you like me to do for your money? And Will Rogers said, it's not the return on my money that's important to me. It's the return of my money that I count on. And the truth is, that's what most of your clients want. They want just to be sure that it's meted out, measured carefully according to their personal preferences. And that's the reason we ask questions. And your investments are not the market. If the market's up 25, you're supposed to be up 25 only if you're 100% invested in the market, which most of us wouldn't be. Your investments aren't the market. Performance is personal. But remember, you'll go broke betting against the American economy. Well, this economy's had it. Well, interest rates are going to drive us crazy. The Fed's going to keep raising the rates. Money supply is going to drop down. We're at all new highs. We've never been in this territory before. Price earnings ratios are out of sight. This has never been here before. You'll go broke every time you pay attention to that and don't trust the American economy. We are in a nation that God has blessed with a growth economy, and your emotions are seldom correct. You know that to be true already, though, don't you? Your emotions are seldom correct. We get emotionally high, we get emotionally depressed, but that really doesn't affect the reality around us. Most of the time, it has to do with a feeling or a sentiment or a worry. But your emotions are seldom correct, especially when it comes to the stock market. Your emotions are seldom correct. That means we have to think through decisions. I want to be emotionally sound. I want to support my decisions with my feelings, but you got to be careful because pessimism will always lose money. So what are you supposed to do? Well, talk to your clients. Listen, when the markets are crazy, that's when you get paid to be the advisor, right? You want to be an advisor. Do you want to be a salesperson or advisor? If you want to be an advisor, talk to your clients. Don't make them worry and call you. Give them a call. Tell them things are looking good. It's going to be okay. Markets we don't understand, but investments we do, and we made a good one. Continue to invest. Listen, if you stop trying to market your products now, you could be costing your clients lots of money because you're never going to be able to tell them the right time to get in. You will not. Stay the course. Help your clients stay the course. If they're doing dollar cost averaging, you know how smart that is. When the market's down, what are you doing? You're buying more for less. Stay the course and get rid of market sentiment. Your clients will listen to that stuff all the time, and all it does is confuse them. Remember, none of these guys truly know what they're talking about. You can't time the market. And pessimism, always going to lose you money. Always. No, that's not going to work. Famous last words. Yeah, I don't believe that'll work. It does work when you invest smart, when you invest consistently, and when you do your research and you buy the right things. And that's why they're talking to you. So don't fall in line with the losers. Don't fall in line with the losers. Don't fall in line with the negative, the pessimists. Don't fall in line. Those guys are walking around saying, oh, market's going down. Oh, boy, oh, boy. Did you read that article? Did you watch Jim? Did you hear what Barry said? You can't do that. Those guys never going to make any money for you or for your clients. So wait a minute. What does this have to do with net law, Craig? Listen, Stan, I thought you were the net law guy. You're not the market guy. Well, the truth is, I am. Because net law is all about protecting your business and your clients. And you are an advisor, correct? People pay you for good advice. So what I try to do in every webinar is to give you good advice that you can share with your clients that has come from my 27 years of being in the markets. Net law is all about protecting your business and your clients. If you protect your business, you will be protecting your clients, right? And if you protect your clients, you will be protecting your business. What are you protecting them from here? What are they being protected from? From being crazy about market timing and what's happening. Net law is all about protecting your clients. That's why we talk about the medical documents. It's the reason we talk about the estate plan. It's the reason we talk about legacy giving. It's the reason we talk about guardianships. It's the reason we talk about family trust. It's protection. Being wise about the future, isn't that what net law is all about? I think it is. And part of that is being wise about your financial future. Why? Because protecting your family and the families you serve is a wonderful gift. You've heard me say many times that when I was sitting in your chair, I told myself I was a missionary for money, that most people do not know how money works. We are totally illiterate as a society on how money works. We don't understand investing. We don't understand the economy. We just become victims of whatever we hear. Once you join this wonderful profession, Once you begin to take seriously your responsibilities, then you understand that no family left behind means your family. And the families you serve, you're providing them a wonderful gift. You're giving them an education. And I love that about the firm. It's not just about selling, it's about educating. And what a joy it is to do that. Financial services is an interrelated business. What do I mean by that? Well, estate planning is what we do in that law, but estate planning is done for those who are financially successful. Those who are financially successful also need to know why a family trust works. If you have a family trust, that means you have family that needs to be protected. That's the reason the medical powers of attorney and the medical living will are so important. And if those things are important to your family now, they're going to be important to everybody. Financial services is an interrelated business. Everything we do somehow touches people's finances, and that's so important. So just remember, protecting your client's assets, that's what we do. That's what we do in that law. That's the reason we're taking the time to show you and to teach you why these estate planning documents are so important. That's why the healthcare documents are so important. We want to provide peace of mind. My goodness, when you go to the hospital, the documents have already been signed. The papers are all in place. If someone is facing a death crisis, you have peace of mind. We know that we've taken care of this. We know the family is going to be protected. What we do in that law is help you have peace of mind to share for your family and to share for your clients. Taking care of tomorrow today, that's why we're here, isn't it? That's what your clients need help with. They really need your help in taking care of tomorrow today. Most of us are too focused on today to even think about tomorrow. We're too tied up to yesterday to even look ahead. You can't do that in our business. Our business is about taking care of tomorrow today. That means today's important, but it's what's coming that we want to be prepared for. And that's what NetLaw does. Serving you, that's the reason we're doing these webinars. I'm not doing these for your clients. These are done to serve you, to help you serve your clients. And that's really our goal at NetLaw. When I came with NetLaw, it's because Jamie Hargrove told me what he wanted to get done and what he was doing with his estate planning service. When I came to NetLaw, I really understood how it could help me get the message to clients about advanced care planning, why the NetLaw MD is so important. We want to serve you because through you, we serve clients. Helping you help others. Yeah, that's it. That's what we do in NetLaw. Well, I hope you found this to be helpful to you today. I hope you found some things that you can share with your clients. If you're recruiting and people say, oh, the markets are not right. If you're thinking about investing and your client says, I have an account, but I don't think it's right now, I hope we gave you some information to help you. If you want to attract new assets to you, this is the time to do it. When people are uncertain, they're looking for people who can help. And my guess is no one who has an account at the bank is getting a call. Very few people have accounts at major broker firms are getting a call because they don't have big enough assets for them to be care about. Listen, I know you care. Give your clients a call. Give them a hand-holding, pat on the back, voice of assurance. It makes a difference. How do I know that? Well, because Mark, Vanessa, and Mary and Jennifer are here to help too. They want to give you a pat on the back. So just call them sometime and ask them for a hug. You get one over the phone. It's about as good as we can do and still be politically correct. Well, this is Stan Craig. I've enjoyed being with you. Check out Step 6 in the App Store. And Mark and Gary, thank you so much for what you do to make these take place. And for you, dear friends, I'll see you next week. This is Stan Craig. I trust you're going to have a wonderful tomorrow because of the time we spent today.